Warm good afternoon. I think it's really getting warm. So, and respected dignitaries on the dais, respected delegates, I'm going to talk about a subject. I think for the last 1.5 days it's been highly technical with frequencies, loads, shedding and non-shedding and stuff like that. But I guess what I'm going to talk about is pretty much nothing to do with that. I will talk from the perspective of somebody who's got to fund all this, and what is a lender actually looking at, And let me tell you, no lender understands any of these that were spoken in the last 1.5 days. That's beyond. Everything is overhead wires, is all that we know. The question is, all the lender knows is that I put my money here and will I get it back? And that's it. Okay. And pretty much what I'm going to talk about is not only specific to ancillary services, it's pretty much to other aspects of lending to the sector as well. So if you go to the basics, look at why is money borrowed, and a lender looks at it as either capital investment or for working capital requirements. That's how the assessment. The moment when somebody is putting money on the table, it's to look at whether you're going to invest in a longer term asset or for your day-to-day operating purposes. And specific to ancillary services, it is very unlikely there will be significant capital investments unless you want to have a black star plant, which is completely dedicated, and therefore you need capital investment. We'll come to it later. But in FSAS and the other segments, lending is primarily to working capital requirements. In terms of telling people what is it that they require from a day-to-day purpose. And a lender just looks for two things: ability of the customer to service interest, ability of the customer to repay the principal amount. That's all he's bothered about. He's not worried about where you sell power, how you sell power, and all that. What is it that he has in it in terms of getting this money back, and how does his customer generate revenues? So when he looks into this, what drives his lending decision? Ability of the customer's business to generate revenue. It's a question of looking at whether you have a demand for the product or service. Obviously, as we had seen, electricity is there. But the question is that, are the counterparties capable and willing to pay for these services, and therefore where do you stand? Certainty of generating the projected revenue. As we had seen in the last two sessions, if you want to resort to shed load as opposed to buying it at a particular price or above a particular price, then obviously the certainty of revenue generation as far as the utility is concerned is impacted. So that's something that lenders are extremely worried about. But they're more worried about volatility. It's a question of unstable, because what happens is that when you lend for working capital requirements, what is actually happening is the bank is actually doing the borrower's cash management. Because you pay interest only when you draw money from the bank. You what is called a cash credit account. So the bank says, fine, you have 50 crores here, but then if you are not going to utilize 50 crores every day, you're not going to be paying interest. If you use only 10 crores in a day, you pay interest only for 10 crores. So what happens is that when there is volatility, when you are fine, you're covered with your fixed charge. But if you are not going to be generating and using, what happens is you are actually not going to be using your credit limits fully. You are not going to be drawing down, which means it is idle cash, idle money with the bank. He sanctioned you, but you're not earning anything out of that. So volatility is one thing which lenders are very concerned about. They say that they end up tomorrow if you don't draw, and then he has to find ways to deploy the 40 crore that you have not drawn, because he's paying interest to depositors on that. So that's something that they're very worried about. So why I'm coming to these is that if we're looking at regulation for ancillary services, FSAS and other things, these have to be kept in mind in terms of how do you smoothen a lot of these things to the extent possible. Obviously there are unscheduled happenings, but how do you try and smoothen this, because that is what will actually help utilities in terms of ensuring that they have a smooth banking operation and lending makes lending possible. And the last thing that bankers always look for is asset cover. Is there something that I can fall back? The guy is not repaying. So typically Asian banking is all about lending against collateral. Not as much as against cash flows that you look at in future. I'm comfortable if I have an asset backing. I mean, irrespective of whatever I would recover, on a later date. But then that's a natural comfort that bankers have. And looking at revenue structure and certainty more closely, which is the key to a lending decision. Primarily, bankers would look at pricing methods. Should it be a bid price? Is it going to be a fixed price? What is it that the contract actually entails? That is something that is very important, because this is also linked to volatility. Volatility in terms of the prices also impacts the revenues, and therefore banks are worried about that. Secondly, structure of the remuneration. Will there be a capacity charge and a usage charge? How does utilities get compensated? Duration of contracts. Typically, lenders love long-term contracts. It really reduces uncertainty to a large extent for lenders. But then, in these kind of services, it is very unlikely. So that's something that would be a drawback that lenders would look at, in terms of when they're actually looking at these kind of services. Price caps, I think we just discussed that point about, price caps with respect to liquid fuel, is something, bankers would shut up. Because they are in no control in terms of input prices, fuel prices. And so if price caps are imposed, then actually what happens to the generator, and therefore what happens to the fortunes, and thereby what happens to the bank. Similarly, regulatory cover would be something that lenders would typically look for, to at least get some amount of certainty in terms of what is the roadmap for ancillary services, how is it expected to clarity. Even we had speakers talking about indemnifying NLDCs or having some kind of escrow to SLDCs. I mean, that's a nice thing to do, but I don't know where is the escrow available to be provided. I think already it's well over and above that. But then, can there be some other mechanisms by which these payment security mechanisms can be brought in? That's something that. The other thing would be extent of competition. If it is, as long as it is some kind of oligopolistic competition, there are only 3 or 4 players who would actually be bidding in this market, that would be a more comfortable scenario. But then there could be 2 types of unhealthy competition. One is, obviously you have 20 players trying to fight out for a small pie, then that is something that is undesirable. On the other hand, there is also a likelihood of cartelization. In terms of trying, if you have few, then if they come together, and then that could distort prices. And these are things that typically lenders are worried about, because they expect a perfect competition as it moves on, and therefore pricing being decided on that. When that gets distorted, then you have trouble. This is a quick overview of what can be or is an expected ancillary service market. I would just try to focus on the last 2 blocks we're talking about. One of the things that can actually be done, taking off from a securities exchange, is to ensure that in these kind of services, this is again from a lender's comfort point of view, in these kind of services, make the exchanges the counterparty. The exchange takes the liability both on the generation side and whoever is the ultimate user, and the counterparty for either of them. So therefore, if I am an FSIS supplier and I am not worried about obviously the utility that is using it, for me the exchange is the counterparty, and which actually happens in a securities exchange. I sell a share, I deliver the share at the exchange, and I get my money. Even if the ultimate buyer does not pay the exchange, it doesn't affect me. I am secured because the seller. Typically, this happens. I mean, in most financial transactions, you have standard clearing houses or counterparties. So now, can you bring this structure? What this obviously would mean is the participants in the exchange have a sufficient margin at the exchange. Otherwise, the exchange will go bust. So the question is that how much. I mean, there are already mechanisms in place. The question is, how can we fine tune this and make it more appropriate in a manner that these exchanges function as good intermediaries which take the risk and at the same time ensure that the transaction gets completed. Without that, there would be a huge risk for the generators in terms of and therefore funding those projects. Typical payment mechanism, how to prevent default by utilities. As I said, escrow is a nice mechanism, but I think those days are over. As I said, can the exchange be the counterparty? Or can payments be assured by the UI pool? Where you say you have some kind of a guarantee, even for the exchange. Let's say the exchange becomes the counterparty, but then, in an extreme case, who takes the risk? Can you create some kind of a UI or a AS pool, which will actually act as a backstop arrangement if everything fails, and then there's somebody who will step in, there is something to some extent, and therefore who will be able to kind of support. So given this situation, typically the likely view by lenders as we see today is AS is going to be a small component in the overall business that the lenders are looking at with the utility, to start with. In fact, some may actually look at AS as a positive top-up. Obviously, if it's only helping utilize some amount of idle capacity, so probably you can look that lenders will also favorably look at it as a positive top-up. But however, where the utility's primary role is AS, which is like if you're a black start that you want to provide, then lenders will be far more worried, and if you need to bring in those kind of facilities and plants, then you require far more regulatory certainty and payment assurances. And without that, it would be extremely difficult, to get those kind of projects funded. So that's all I had.